Hey everyone, hope you're doing well. This is the Deep Dive. My name's Drew Creekmer. I'm the Director of Advisory Services here at Creekmer Wealth. And I'm joined, as always, by John Creekmer, our founder and senior wealth advisor. And John, we're going to talk about some current events going on in the economy and in the markets. There's a lot of movement now, and it's movement that we really been waiting on here for the last couple of months. We've been anticipating it. So we want to dive into that and just keep everyone up to speed. But before we do that, how you doing today?
I'm doing great. I don't know if everyone knows. You can probably tell if you go back and look at previous deep dives. I've dropped about 24 pounds since the 1st of April, and got a target to knock another 16, 17 off here the next 3 months. And so we'll see how that goes. But it's interesting. A lot of that, we're doing a lot of work as far as with just looking at numbers and levels from a health standpoint, and working with a couple of specialists and integrative medicine, a couple of focused people as far as health and nutrition that I brought on board to my team. And as we're looking at numbers, we saw a number of things that were trending. So we made some adjustments on some fundamental things that I was doing with nutrition and general health. And I'm getting a little bit older, so I'm 54 now. Things change a little bit. And in doing that, we had some great results that put me in a better position. So whenever stress comes and whenever stuff of life happens, we all go through it. Right now, we're with some family things and care for extended family members right now that ramped up the stress level. We're in a better position to actually handle that, and so we can all see that on the personal side of things that we're doing, but also that does apply as far as in the markets, the things that we're looking at, even managing portfolios. It's a very similar story.
Yeah, yeah, it definitely is. And so I know you kind of set us up to walk through this, John. So let's talk what's going on in markets. So far, you're a pretty strong year in markets, but I want to put a graphic up on the screen that shows year-to-date performance of the S&P 500, and there's little blue dots on this chart. And the blue dots that are to the right of the black arrow through the middle of the screen, those are the 30% of stocks that really are largely responsible for the total return of the S&P 500 this year. And whenever you see a very small group of leaders driving performance in markets, while the majority are lagging, John, that's generally a sign that there's weakness underneath the surface of the markets and underneath the surface of the economy. And here, the last couple of weeks, we're starting to see some volatility and downside in the market return. And so when you look at markets today,
Yeah.
what's really standing out to you?
We've had a lot of concern for the last couple of years. Look at 2023 as a great example. At one point in 2023, the S&P 500 was up approximately 14% for the year to date. This would have been back at the middle about a year ago, here in the middle of June of 2023. And of that, over 90% of that increase was comprised of the movement in seven stocks. So, of 504 holdings inside one index, seven stocks gave outweighted performance impact. Then we saw that trend continue on this year. Now, it's like you're saying, it's a little more pronounced. I believe at one point we had over 70% of the stocks of the S&P 500 were negative year to date, and yet the overall index was up mightily, over 10%, 12% as far as a year to date number, at various points in time. And so, what that really speaks to is we see a market um, that is actually has a lot of foundational cracks. So whenever we see that, that's generally a time that you want to be taking profits off of the table. And I know there's this fear of missing out of the very last 2 or 3 or 5% on the upside, but you can't be worrying about that because the downside comes very sharp whenever there is a triggering event. And so there's lots of triggering events that can happen. You can think of a macro event, go back in history and look at some significant triggering events, such as a September 11th of 2001. Or if you look even in 2008, when we saw things collapse from a mortgage standpoint or real estate collapse, that's a triggering event. Or it could even be things such as we're starting to get a lot of negative numbers underlying as far as in the economy. And so any number of triggering events can cause things to actually move the other way. And so you always want to be preparing for positive and negative triggering events.
Yeah, yeah, absolutely. And John, we've done a lot of studying with an analyst that we work with on our investment committee, going back and looking at past bull markets and timing out how long do they last on average. And what we found is they usually last 18 to 24 months. And when we took a look at where we were today, you spoke about the cracks in the market. We were squarely in that 18 to 24-month window when bull markets tend to end. And so here the last couple of weeks, we've seen the S&P 500 and the NASDAQ begin to draw back. And John, what did we do in preparation for that potential occurrence in our client accounts?
Yeah, there's a lot there to unpack, Drew. It's interesting. You had mentioned our investment committee. Let's take a second, if we could, and kind of talk about that,
Yeah.
so folks just understand that it's not just you and I sitting around pontificating on what we think. And so we have two different outsourced partners that we brought into our investment committee. The first one is a firm that is a group of CFAs, Certified Financial Analysts. And this group is statisticians, and what they're really looking at is the underlying fundamentals of the market, and how are things moving. And then they give us information, and they look at our portfolios, big picture as far as our models, and then they give us direction on what they're seeing. And so they have been invaluable on being able to provide us really that deep dive on the fundamentals of the market. The second firm is a firm that really is more of a technical side. There's two ways to look at an investment. One is fundamental, and which looks at the, let's say, the individual company. You're looking at the debt, you're looking at the earnings, you're looking at growth numbers, you're looking at trend lines for a specific company. So that's fundamental. Whereas technical analysis, all that's looking at, it doesn't care about the quality of the company. It doesn't care about the economy per se. What it's doing is it's listening to what the market movement is telling us. And so, in other words, are we seeing trend lines or movement up or movement down, or what is the momentum and shifting? And so we receive input from both sides, and we take that as far as to give us direction on how to handle our investment decisions. And we have four internal employees then that take the information, and then we work together to apply it as a collective. And so we get best thoughts and best ideas and sharpening on that. And so you had talked about this study that we've been really researching and looking at, a bull market when the market is moving upward in an upward fashion, upward to the right. They last typically between 18 and 23 months. When we see a negative market, they last between 5 and 7 months on a negative trend line. Right now, we have just entered the 22nd month as far as of the current up market. And so that means that we are clearly in what's called the kill zone. In other words, if you have new dollars to deploy, you're in a situation where you might want to make sure you're very cautious in how you deploy that. And maybe you keep the powder wet or keep the powder dry. And so in that, we've been utilizing a lot of short-term bond funds of less than 30-day maturity, being able to take advantage of a 5.15 to 5.25% yield on that while we're waiting for markets to move and adjust. So right now we're seeing those underlying cracks starting to show, Drew, and we've actually positioned for that. We'll talk some more on the cracks here in a second. Let's let me hop into that now. But there's a number of things that we've been watching on that.
Yeah, absolutely. And so, I think big picture, all of the study and work and development we've done inside of client portfolios has really prepared everyone for this moment that we're walking through, where volatility is coming back and some cracks are beginning to show in the economy. So we feel very good about performance in client accounts and how everyone's positioned. And we're going to continue to watch the data and see how things play out here in the months ahead. Now, Johnny, I know you mentioned the cracks, so let's hop into that. This week, there was a ton of very important economic data that came out. There was a Federal Reserve board meeting that occurred where we finally got some clarity on inflation and interest rates. And so, John, why don't you walk through really the major data points that stood out to you that came out this week?
Yes, we all talk about inflation, and what is inflation? It's the rising cost of goods and services in our society. We know that at one point, 18 months ago, we were sitting and hovering a little around a 9% inflationary rate as far as year over year. It's that's your milk, your bread, your gasoline, your clothing, and all those different items kind of factored in. One thing with inflation, inflation is accretive. That means that it simply adds and it continues to go up. So even though the inflation rate or the growth in those prices may actually decrease to a sustainable level, 2 to 2.25%, that does not mean that we see a decrease in prices. So that we call it a deflationary time period. Now, there might be some prices that go down or deflate for reasons that are not tied to supply and demand. And so those reasons could potentially be advances in technology. And so even though we saw an increase in the price of a lot of things, I know I just picked up a new 46-inch TV for my office here. It was actually about $75 cheaper than the one I bought 12 months ago. And so we are seeing decreases. That's because the price of some of the goods actually goes down. If you look at rising wages, and so a lot of states have enacted higher minimum wages. Well, as you say, maybe it takes 8, 9, 10 different levels to get the end product to you. If every single one of those levels saw a $2 increase as far as in the wage they're paying, well, then all of a sudden, then that's going to have an accretive effect, right? So we have seen inflation or the growth in the price of goods and services actually get down to a decent level. So year over year, looking at 3.2 to 3.3%. And so we're getting very close to that target rate of 2.5% by the Federal Reserve. And what we saw from Chairman Powell, who has been very, sometimes I think a little slow on moves, but they definitely have telegraphed what they're going to be doing in coming days. You have to kind of read between the statements sometime to get there. But recently, they've indicated that inflation they think is getting to a point where it's actually sustainably under control, and a potential of a quarter of a point decrease coming up in September. Now, we believe that we really think a quarter of a point decrease in the fourth quarter is probably not going to be sufficient. I believe that they have been a little bit slow. I think they have been slow for the entire cycle of the last 5 years as far as movements on interest rates. But it's just they were slow as far as in raising rates, as far as to combat inflation. And so we really think we really probably need more of a half a point to three-quarter of a point decrease in the next 4 to 5 months. The reason why I say that is that we are students of the employment cycle. I think that you're able to find, and history has proven, you can find and identify economic cycles based on what's happened as far as employment. This morning we came out with some employment numbers and new jobs created. We had an estimate that there would be 185,000 new jobs created. And when the report came out, this is last month, when the report came out, there's only 114,000 new jobs created. And so, and the unemployment rate also climbed to 4.3%, which is that's the highest unemployment rate we've seen since October of 2021. Drew, there is something called the SOMS rule, and Sam was an economist. And SOMS rule is an indicator that tells us where we are at as far as an inflation cycle or a recession cycle. And what SOMS rule states is this: whenever you are at the 12-month low on unemployment, if there is a half a percentage point increase for a 3-month average over the trailing 3 months, that tells you you're entering a recession. So the 12-month low was 3.5%, was the 12-month low on unemployment. Our last 3-month average of unemployment is actually 4.13%. So that means we're actually 0.63% above the 12-month low, which indicates we're heading to a recessionary period of time. That's why we believe the Federal Reserve will probably end up decreasing interest rates at least by a quarter in September, and maybe again sometime in November after the election. And so that's what I'd say to plan for. Now, when the economic numbers came out over the last couple of years, you have bad economic numbers, stock market goes up. But right now, the market's already priced in at a quarter of a point. Those numbers came out and the market sold off pretty heavily today.
Yeah, yeah, it did. So what we're seeing is we're kind of getting back to more traditional
Mm.
economics and relationships with markets, right? Seeing bad economic data leading to a down market, which we don't like a down market. We don't like bad economic data, but it's good to see that that relationship is starting to be restored. And so, big picture, John, definitely seems like now is the time to be a little bit more conservative in investment accounts and a little bit more cautious. How would you view the economic where we're at today with how one should be viewing their investment portfolio?
I think that's a great question. So right now we're looking at lengthening out maturities inside our fixed income. If you have CDs, which we have a lot of CDs on our platform right now, we're seeing some brokered CDs with some great rates. We're actually starting to look to potentially be shifting to lengthening out sometimes on those. If you have, let's say, if you have another fixed product, let's say you have an annuity product, you're going to want to consider and review those pretty quickly here. If you've not, what we call refinance or actually upgraded those, here in the last 6 to 12 months, you want to consider doing that because rates will be going down. I saw some adjustments on rates actually this morning come across, so you want to consider doing that. Now, as it relates to other equity-based accounts, we continue to see a shift in the small company value and mid-sized company value, and also into dividend payers. And so that being said, those are the areas we think give us a little bit more stability. When there is instability, we look for areas that give us higher level of earnings. We look for areas that are not as sensitive to the economy as far as the whims in the economy. Those are stable names, low debt levels with high earnings potential and high growth rates. Are the ones we look for. Consistent growth rates, better way of saying, I guess. And those with dividends because they have cash on hand. So we look at shifting in there. And Drew, we've already made a number of shifts as far as across in our major portfolios, which would be inside our growth and income stock portfolio or value position. Also inside our growth stock position and also our ETF based models. Would you want to walk through what we're seeing there as far as those adjustments and over the last 2 months in preparation for this and how that's benefiting clients?
Yeah, absolutely. So, across all three of those, the adjustments are fairly similar. Where number one, we've taken gains off the table and raised to a very strong cash position where we're currently earning just a hair over 5% interest. We're anywhere from 25 to 35% in those three models, sitting in short term treasury bills, earning a nice rate. So, we have no risk of the market affecting those funds. We've also shifted to be more overweight to, as John said, value or income producing equities. For example, in our passive equity ETF model, now we currently have 32% invested in dividend payers in the Dow Jones, which traditionally hold up much better during periods of stock market volatility. We made those shifts because it was becoming very clear that the Nasdaq and the S&P 500 were topping out, and a number of those big growth names that we talked about at the beginning that were driving performance were really starting to stall out. And so we took some gains off the table proactively, went to a more conservative position, and increased value and income producing stocks across all three of those models. So really been pleased with performance there, John. And it's been really great as well to see it the last couple of weeks. When the market's been volatile, those individual models have held up very, very nicely as well. So we feel everyone's in a good spot as we enter the next couple of months. And we're going to keep an eye on the data and keep an eye on the markets and make adjustments as we need to as we see things play out. So, John, we covered a lot of ground here, and we definitely had some very important topics. But what's one thing that you want everyone to keep in mind here as we move into the month of August and the latter half of the year?
I'll tell you what, it's so interesting because right now we're at a point of heightened volatility. We've kind of been saying that is coming for the last number of months. And keep in mind, folks, over an entire cycle, and now the cycle is going to be your time period that you need to access the money. So maybe it's 5 years, maybe it's 10 years, maybe it's 50 years. There's always periods of time which you have increased volatility and was actually negative performance in the equity markets. You want to make sure in those seasons you don't react emotionally and make a decision which gets you off path. And so always make sure you're connecting with your advisors. They have some very deep technical tools. They're able to show you how you're going to begin accomplishing your goals, even in periods of time of negativity. And so make sure you lean heavily into your advisors. Make sure that you walk through things logically and always stay focused on what those end goals are and how are we doing to get to there. I think that's critical moving forward for the next number of months.
Yep, absolutely. I totally agree with that. So, guys, if you have any questions that were surfaced from today's conversation, or you just want to touch base with your advisor and see how you're doing and tracking towards those end goals, we would encourage you to reach out. Our team is standing by and ready to help in any way that we can. And otherwise, we'll keep things on the tracks and keep rolling along here, John. So, thanks for the time, guys. We'll talk to you all soon.